Good morning and welcome to the 21st Annual Market Outlook hosted by Bender Commercial Real Estate Services. I'm Michael Bender, one of 6 partners here at Bender Commercial. And on behalf of our entire team, we're very pleased that you're here this morning. I ran into Dave Osted this morning and he told me a story that I thought I'd share with you. He was in Nashville, Tennessee recently, and I think they had maybe 2 to 3 inches of snow. And he said the whole town was shut down. And they couldn't go anywhere to the National Country Music Hall of Fame, anything. He got up this morning and he said, there's no way Bender's canceling this thing. So you are the Hardy Few, the South Dakotans that we all know and love. So welcome. And again, we hope this information is valuable to all of you for your business decisions in the coming year. Before we get going, I want to draw your attention to this program, if you did pick one up. We added this year a couple of things in there that you may find valuable. We added a couple definitions of net absorption. You're going to hear that phrase quite a bit, and of cap rates. You're going to hear that as well. And then finally, we added a description of the real estate cycle. And that's a classic real estate cycle where it rises up, rents increase, inventory increases, all the lenders loan a lot of money, and then we get overbuilt, and then we start to see the downward trend of declining rents, high vacancies, and we bottom out and then start the cycle all over again. As you hear the presentations today, I encourage you to think about where you believe we are on the real estate cycle. We make that prediction, many of you know that because you've been here. We make that prediction at the end of the presentation for each one of my partners. But begin to think about that cycle and where we fall on that cycle as you hear the information unload. So, take that in. And then I do want to acknowledge one individual that's here today. Mayor Mike Heather, this will be his 8th year at the Market Outlook in an official capacity. He's attended in years prior to that. I consider Mike a friend of mine. And more importantly, Mike has, like I, has fallen in love with his adopted city. And so I just want to tell you how much I appreciate his courage. He put his political courage on the line a number of times, his leadership, and his desire to make Sioux Falls a better place for all of us. So with that, would you please help me in thanking Mike? Thanks again, Mike. We're going to get going here, and if you haven't been to this, it's fast-paced. You don't need to take notes necessarily because this will all be loaded on our website. Summer does a great job of loading this and many other things by this afternoon, so you can get the real nitty-gritty detail, but this is designed to be fast-paced. So buckle your seatbelts and let's get going. The first 2 slides I want to show you, I've introduced to you before back, and you'll see the context of why I'm reintroducing them to you. The first one is the total debt outstanding held by institutions across the United States on all commercial and multifamily real estate. You can see on the bottom about $3.1 trillion is outstanding in loans across the country on real estate. Now to put that in context, $3.1 trillion, it's a big number obviously. The U.S. equities market is about $18 to $19 trillion total. The U.S. bond market is about $80 trillion. So it's still in the trillions, don't get me wrong, but it is relatively small in the global financial markets. But nonetheless, it's down from about 3.5 to 3.6 trillion a couple of years ago. You can see that the banks hold the majority of that debt, not the majority, but 40% plus or minus. Agency debt is second biggest. Agency debt is Fannie Mae and Freddie Mac, so that's mostly multifamily debt that you see there, that 18%. And then you can see the other lenders that loan on commercial real estate throughout the country. The next slide is really the one that I think is in context for today. And you can see that now we take it out based on maturity. And I introduced this to you in about 12 or 13, I believe it was probably 12 if I'm not mistaken. And at the time, I talked about how we're going to have to deleverage our industry. And you can fast forward now to 2018 and see we very successfully deleveraged our industry. And now we're to the point where landlords, as they approach this next downturn, and you're going to see signs in this report as we're a leading indicator of what the economy is doing. But as we approach this next potential downturn, wherever it may be and whenever it may be, landlords are much more nimble and they can react better because they have less debt burden. They can handle vacancy better. So this bodes very well for our industry going into 2018 and 2019. So I wanted to just frame that for you to show you that. Well, let's turn our attention now to the U.S. economy and specifically the Sioux Falls economy. We always start with job growth because that really fuels the local economy. The U.S. economy grew at about 1.5% last year. You can see it's down slightly, but nonetheless a pretty healthy job growth in percentages. And the South Dakota economy, you can see, only grew at about 0.9%. Now, most people will attribute that to ag, which I believe is true. The ag economy dragged the state's job growth down pretty dramatically, and it's certainly dragged the sales tax down in a number of things. But let's look at Sioux Falls economy now, and you can see it kind of limped in. It was only 1% last year, and certainly ag has an impact to the Sioux Falls economy as well. But I believe there's one other issue, a major issue, and it's no secret to anybody in this room. We have the demand. I mean, we could see growth like we saw in 2012 and way back in 04, I believe, 05, where we were above 3% job growth. What is that? It's human capital. We have a supply problem. Not a demand problem, but a supply problem. And we have a workforce development issue. And again, that's no secret to anybody in this room, but it is going to continue to drag on our economy from a job growth standpoint. So I know there's a lot of initiatives out there, and we need to continue to support those with our time and our finances to help our economy grow through workforce development. So what this means in raw data is about 154, almost 155,000 jobs in our MSA. That's non-farm jobs, that's seasonally adjusted, and that's December to December, year over year. So about 1,600 to 1,700 new jobs were created last year in our economy right here in Sioux Falls. Well, jobs always equate to construction and to the real estate market, so let's look at what it did. Again, this is a number you've heard already before. It's not a secret. $739 million last year was spent in permits right here in the Sioux Falls market. What I do want to draw your attention to really is the relationship between the commercial and the residential. Generally on those record years, commercial outpaces residential because they're just larger projects. There was an anomaly back in 14. Ironically, that was the year that the city the next year took multifamily construction out of the residential and put it into the commercial, because it really is more commercial construction than residential in a sense. So you can see this year, that relationship is about 63%, about 2/3 was commercial, 1/3 residential. We grew about 5% last year. And I expect we're going to continue to see a healthy growth. Whether it's going to be a record remains to be seen. Well, taking a look now at just the commercial construction, and we always break that out. The city does a great job for us of new construction versus addition remodel. And we've highlighted for you the last recessionary period, but I could tell you if we went back to the prior one in 01 and 02, the same thing would happen. New construction dips during a contracting market, and addition remodel goes up. And you can see the last 4, 5, 6 years, we've been in an expanding market. So new construction has outpaced addition remodel. This last year, it's still a healthy margin, $70+ million, $73 million in new construction outpacing addition, but the gap is closing. So does that tell us something as we move into a more mature market that we're in right now? Now, breaking out the new construction a little further, I want you to focus on 3 main categories up there. the office, the industrial, and the retail. The office, you can see, was relatively stable, and about 46 million last year in total construction. Retail dipped down, which we did predict would happen in construction. And then industrial came up quite dramatically, which we also predicted. Not quite as dramatic as that chart shows you. But those three really make up the majority of the commercial real estate industry and new construction. I want to put up for you a slide that shows you the multifamily, and you can add those three together and they still don't equal the total multifamily construction even from last year. And you can see last year was a dip from the year before. So that tells you something's going on in the multifamily. You're going to hear about, obviously, the vacancy rate and some of those investments by Nick later on. But that gives you an indicator that something's going on in that multifamily market that may not bode well in the future. Well, turning our attention to some examples of the new construction from last year and the addition remodel. You know, I introduced to you a phrase several years ago, a concept of the producer price index outpacing the consumer price index. The producer price index, it relates to all commercial related construction, labor, etc. And by about a 3-to-1 margin, construction inflation outpaces consumer inflation. So what we're seeing as a result of that now, fast forward 3 years later, we're seeing much larger projects. And so as a result, we're seeing record year over year over year. That's not a surprise to me. But it is a surprise that we're having to pay a lot more for things that are a lot less. And the example is that downtown transit station. The city got a federal grant for $1.6 million. So that's an example of where we're starting to see a lot more dollars being spent. And so those resources are getting taken away from something else, unfortunately, in our community. Well, let's look at it in comparison to some other markets. And I always like to do this. Sometimes we put up populations so we can see on a per capita basis. This year we put up the number of permits, so you can kind of sense who's permit crazy and who isn't. It looks like Minnesota requires a permit to do anything, apparently. But the one I like to focus on this year is Lincoln, Nebraska. They're about 40% bigger in population, and yet we are just barely behind them in total construction. So that tells you that we're doing something right here in this community, no question about it. And we'll continue to monitor that and see that as the year progresses. Well, just wrapping up my part of the presentation, I want to make a few predictions. And, you know, as I mentioned, job growth, I think is going to be challenged. I think we're going to see maybe 1,500 or 2,000 jobs. That's a point, 1.2%. And again, it is not a demand issue in our community. It's a supply issue. And so, unfortunately, that's going to hold us back a little bit this year, I believe, and possibly the years to come, unless we can continue issues and work through some issues here in our community and our state and our nation, to be honest with you. Construction, I think you're going to see some predictions. You're going to hear a lot more detail about these three categories from my partners. Retail, we think, will be flat. Clearly, office is going to be up. Between the announcement of Citibank and Avera and Louise, you're going to see that's $150 million right there, just in new office construction in 2018. Industrial is going to be flat, so to speak. Residential, I want to focus on. Single family is going to be flat, but again, put that in context to this last year. Single family permits were 800 new homes. That's a healthy market. So flat means it's going to be stable. And then clearly you're going to hear more about multifamily, and we're predicting that that's going to be a pretty dramatic drop in the new construction. So that wraps up my presentation, and now I'm going to have Reggie come up and talk about the land market and about the retail market. So, Reggie?
Thank you, Michael. As he stated, we're going to start with the land market, and then we build on each asset class from there and into each retail or the four asset classes. We're going to start the retail, start the land sales. Starts with the bulk farmland on the edges of the city, which is traditionally purchased by the developer. After they add infrastructure, water, sewer, platting fees, dirt work, deliver build-ready lots to the community, they're purchased then on a per square foot basis. We always start with the unimproved land sales. Last year, I predicted that we'd have a decrease in the amount of bulk land transactions. However, wasn't the case. I was wrong. We had 8 transactions in the last 3 years. Let's take a look at where these historically have been. Probably no surprise to anybody in here that the south and east quadrants of our city are littered with growth. I've seen a ton of development in the last 5 to 7 years. It's overlay 2017. A lot of things to take away from this slide. 4 out of the 8 of those transactions were on the very southeast edge of the city. The other 4 were all west of I-29. Take a look at that transaction west of I-29 between 12th and 26th Street. 38 acres, sold at year end for $4 million. That's a big sale. Now, why is that? Well, that is an infill site, meaning that development has occurred on 360 degrees all the way around it, so it is more valuable. Another thing to take a look at on this slide, the city is nearing capacity for sewer on both the west and southern boundaries. So in the next 3 to 5 years, I would predict that we're going to see a lot of growth on the east side of the city and in the northwest. And one other thing that we noticed this year, kind of a unique trend, of those 8 transactions, 5 of them were for commercial development only. An additional 2 were for a mix between commercial and residential. And only 1 of them was for single-family development, which we'll touch on more here in just a little bit. Now this year we added a new slide. Historically, the developers 10, 15 years ago would go out and buy 80 or 160 acres and they would develop in phases over time. That's just not the case anymore. Now we've graded the area between 40 and 80 acres here just for a reference. Let's take a look at the last 7 years of bulk land transactions in size by acres. We talked about this trend last year, these transactions getting smaller and smaller. Why is that? We think there are 2 primary reasons. We saw that the growth, a lot of these transactions occurred in southern Sioux Falls. And as we talked about, the sewerability of that land is very limited. And these developers and their lenders probably are not letting them overextend themselves into buying additional 40 or 80 acres that does not have sewer access and no planned access for that sewer in the next 8 to 10 plus years. They're just not willing to overextend themselves. And the second reason, coming out of the recession, 2011, the city had an issue. Some of the developers didn't finish their infrastructure. They got in a little pickle and didn't finish their infrastructure. The city enacted some new ordinances to combat that. And now it requires the developer to guarantee that infrastructure via a bond, a letter of credit from their bank, or cash in reserve. And again, it limits their ability to buy additional land. Now we're going to overlay this with the price paid over the last 7 years. 3 things I want you to look at here. 2011, land was on a clearance sale. Coming out of the recession, developers bought a lot of land for a low price. Fast forward to 2017. We bought a little bit of land for a big number. The average price paid for development ground in the last 7 years has gone from about $25,000 an acre to $55,000 an acre. A massive run-up. Let's take a look at now, we're going to look at the single-family slides. This is transitioning now into some of the improved land. We always start here. This generally drives, generally speaking, it drives those bulk land transactions, the need for single-family permits. Now, the blue bar is your permitting. That's the amount of single-family permits that were pulled last year. The yellow bar is your supply. That's the amount of build-ready lots available in the city today. It's gotten pretty tight. Less than a 2-year supply. I think that you're going to see single-family lots get even tighter in the next 24 months, and pricing is going to spike up. Now we're transitioning to look at the commercial land, the per square foot land we talked about in our intro. We just heard Michael's report. Construction's at an all-time high. Things are feeling pretty good. We were surprised to see another drawback in the amount of land transactions last year. Now, land tends to be the leading indicator of some of the, especially on the construction side, on the commercial side in Sioux Falls, in all markets, because The end user buys their improved land, they pick their contractor, their architect, their site design, their planning, and they ultimately pull a building permit within generally 12 months. So I think what this tells us is that it's going to be another healthy year of construction, but we may not hit a record in 2018. Is there more to the story? Let's break this out one more step. Each individual asset class, not really. All 4 of them saw a reduction in the amount of transactions last year. So what did that do to pricing? A couple things I want you to look at here. Take a look at the retail land. 2016 to 2017, the average price paid, or the mean, almost a 20% reduction in the retail side and a 10% reduction in multifamily. Some interesting trends to watch. Conclusions and predictions in the land market. I think the unimproved land sales will go down this year, but pricing will go up. Sellers' expectations are at an all-time high. The developers that are competing are going to have to compete for this land, and it's going to drive the price up. Pricing in the other sectors, I think we're going to hold pretty steady, with the exception of multifamily should see a decrease. We're going to look at retail market now, and we're going to go right to a vacancy slide. I want you to go straight to the bottom. 16.7% vacancy. That's a huge jump. Now, it doesn't quite tell the whole story. In the last 6 months alone, we've added 2 Kmarts and a Hobby Lobby into our vacancy factor. If we take those away, we're closer to 10%, which is pretty healthy, but it's still higher than we've been in the past. Once you look at the southern retail, 57th and Western, 57th and Louise, and 69th and Western. The last 4 or 5 years, there's hardly been any vacancy in southern Sioux Falls. We're starting to see some turnover in those malls, and it's just an interesting trend to watch going forward. Why all the vacancy? Well, by my count, 15 restaurants have closed in Sioux Falls in the last 12 months. Now, some of these sure have been rebranded or a new concept is open in their place, but many remain vacant. That's at about an additional 75,000 square feet of vacancy added to our vacancy factor. The other thing, the next slide is zombie retail. For the last 3 or 4 years, I've stood up here and predicted that we're going to see big box availability. Sooner or later, I was going to be right. Kmart left, they vacated 2 stores in our market last year. We touched on that just a little bit ago. But many national experts believe there's a tsunami of zombie retail coming. 36 million square feet in the US in 2018 alone. There's more coming to Sioux Falls. Now, all is not negative. Lake Lorraine was clearly the shining star of the retail sector. They've got an impressive lineup of retailers, and I think you're going to see more announcements and more construction coming out of Lake Lorraine this year. Some areas to watch, no surprise to anybody in here. Lake Lorraine, Dolly Farm, 85th of Minnesota. One other one to watch this year, 69th and Cliff. Look for some additional announcements in 2018 as that development gets kick-started. Take a look at sales real quick, just a snapshot view. You're going to hear Nick break down some of these individual transactions in just a few minutes. But really the thing to look at here, we see 40 transactions in 2016, we slightly decreased in 2017 down to about 34, but the sales volume stayed roughly the same at about 40 million. Some conclusions and predictions. With all that big box availability, we're going to start seeing some of that space being absorbed. And you're going to hear a few announcements here in the next couple of months about some of that absorption taking place. As far as rental rates and construction and sales, we think that's all going to hold pretty steady in the retail sector in 2018. Sorry, I almost forgot my real estate cycle side. We saw a spike in vacancy. We had moderate construction. We had moderate employment growth. I think we're pretty much clearly tagged right in the beginning stages of hyper supply in the retail sector in Sioux Falls. That shouldn't be cause for alarm or any concern here. I think we're simply in the bottom of the 7th inning, and we've got a couple years of runway to burn. With that, I'd now like to bring up Andy Anderson to present on the office market. Thank you.
Thanks, Reggie. My name is Andy Anderson. I'll be talking about the office market this morning. The Sioux Falls office market has a total of 14.65 million square feet. Now that's a 244,000 square foot increase from the previous year. Now remember, that's inclusive of both owner and tenant occupied properties. As I move forward, I only focus on the tenant occupied due to the fact that that's what really affects our vacancy and rental rates. And like I always do, I like to start off at the heart of our city, the downtown sector. We did not see an increase in this sector's inventory, which may really surprise some of you, considering we added Uptown, Washington Square, and the Argus Leader building was converted from once owner-occupied to now tenant-occupied, adding that square footage back to our inventory. However, we had another major conversion, the Great Western Bank building, which is now going to be a hotel, pulling the square footage out of our inventory, resulting in it being flat. And even though we added square footage to this sector, some of that was pre-leased, some of that was vacant, resulting in our net absorption to be negative by 144 square feet. And when you have negative net absorption, vacancy rates typically don't change, and it didn't. We're still sitting at 6.8%. Now, some of you may wonder, how low is too low? Should we be getting concerned in this sector? I don't think so. We have a couple of new, really exciting projects on the horizon for the downtown sector. And it'll really change the look and feel of downtown, but more importantly, offer up new opportunities for tenants to consider, which is great news for this sector. Now let's shift gears to the suburban sector, which is everything excluding the downtown market. We have a total of 5.5 million square feet. Now that's a 2.7% increase from the previous year. What caused that increase? We had 13 newly constructed office buildings and 6 conversions take place. What's interesting is of those 13 buildings, all of them were less than 10,000 square feet. So I think this is an interesting trend we should continue to watch, where tenants want to not only own their buildings, but control their potential expansion and maybe even have another tenant in place to offset some of those expenses. And obviously the interest is really focused on the south and southeast side of town. And just like we saw in 2015, we had a huge jump in our vacancy rate. We went from 8.9% to 11.9%. That's a big jump. So what was the cause? 2 of the 3 city buildings were recently placed back on the market, available for lease. This added 250,000 square feet to this sector. Now, if those buildings were not put on the market, this sector would have been at its lowest it's ever been, at 7.4%. Now, what happened in the suburban sector? Basically, supply was greater than demand, resulting in our net absorption to be negative by 34,000 square feet. Now let's shift gears, take a look at things as a whole. This slide represents our citywide vacancy rates, and as Sioux Falls has historically been, we're lower than the national vacancy rate, which is sitting at 15%. Sioux Falls is at 10.4%. And this slide represents our asking rental rates, net of all of expenses. Over the past couple of years, we really haven't seen a significant change in any 3 of the class categories. And I predict that we won't see a real significant increase or drop in rental rates for the next year, if not potentially the next couple of years. Now let's shift gears from office leasing to office sales. We had a total of 29 buildings sell for $55 million. What's interesting is the range of what these properties sold for. They sold for $379 a square foot, all the way down to $54 a square foot. And now remember, the office market in Sioux Falls is fairly small compared to other markets. So really 1 or 2 buildings can skew our numbers significantly. And that's pretty much what happened for the most part in the suburban sector. And that's why my predictions are such. I think our vacancy rates are going to increase just slightly. I think absorption and rental rates will remain stable. And I think that trend of tenants really wanting to own and control their own properties is going to continue, and construction will increase. And with those predictions, that really puts the Sioux Falls office market right on the verge of hypersupply in the real estate cycle. And with that, I would like to bring up Rob to talk about the industrial market.
All right, thanks, Andy. As Andy said, my name is Rob Fagnan. I'm going to be presenting on the industrial market. We always like to start off by displaying all the various uses that make up the industrial market, and oftentimes we like to refer to this collectively as our industrial universe. The Sioux Falls market this past year added 29 buildings to its survey, coming in at about 17.65 million square feet. Harrisburg, there was a ton of activity down in that market. However, there wasn't a big increase in the total square footage. They continue to hover right around that 2.7 million square foot mark. And finally, after years of talking about it, we added the Brandon market to our survey. But 100 buildings with 1.7 million square feet. Now you add all these up, our industrial universe is sitting at about 22 million square feet. Now if we rewind back 10 years, we've nearly doubled the size of the universe within our market here. So I predict we'll probably see a lot of that same expansion over the next decade. Traditionally, we always like to take a look at the difference between owner-occupied space and tenant-occupied space. And I could probably give a presentation on this slide alone, but I'll spare you and just highlight a few things. I want you to focus in on the Brandon pie chart. Brandon's sitting at about an 80-20 split between owner-occupied and tenant-occupied space. This is exactly where Sioux Falls was at about 10 years ago. So if you shift your focus over to the Sioux Falls pie chart, you might be wondering, why has there been a 12% drop in owner-occupied space in Sioux Falls? Well, there's a number of reasons, but I'm just going to highlight one that I think has really driven this down, and that's as Sioux Falls has continued to grow over the years, so has the migration of regional and national companies. Oftentimes those companies prefer to lease space, which in turn drives up the demand for that tenant space. So that's why we've seen that shift over the years. And one of the main reasons that we've seen so much spec construction take place this past year, which I'll talk about in a second. Okay, speaking of construction, 2017, record year in the industrial market for new construction. Last year I predicted we would see a strong year, not a 50% jump year. So I was a little off there, totaling about 770,000 square feet. Now I don't have pictures to show you, I can't plop up 20 plus pictures of all these different buildings that were built. So I just wanted to highlight a few of the spec buildings. The two on top were in Sioux Falls. The two on the bottom are out in the Brandon Corson Industrial Park. These ranged anywhere from 10 to 30,000 square feet. Now the building in the upper right-hand corner, that already has a tenant occupying 12,000 square feet in that building. I would like to note, we saw a record 15 spec buildings get built this past year. It's by far the most we've seen over the past 10 years. Okay, on to vacancy. With all that new construction, no surprise that we have a little uptick in vacancy. 2014 through 2016, if you remember and you were with us in the past, we kind of fumbled around in that uncharted territory for vacancy and finally saw that spike up to 3.7, which is really the norm in our market. If you look back over 10, 15 years, we've hovered around that 3.5% to 4% range. I'd also like to note in the T and Harrisburg market, again, you heard me say a lot of activity down in that market. Well, there was a lot of absorption that took place. And they dropped their vacancy rate from 5.66 down to 2.78, about 3%. Brandon, with some of those new buildings that got built, they're hovering right around where Sioux Falls is at. Let's take a look at net absorption. For years, you know, we saw this run up in positive absorption. This is the first time that we've seen a fairly significant drop in net absorption, about 25% since the recession. Now, the biggest point I want to drive home here is that vacancy slide before this and net absorption. If we continue to see vacancy increase and absorption is decreasing, we're going to shift from being in a seller or landlord's market like we've seen for so many years. That'll shift into a tenant and buyer's market. So we'll keep an eye on that throughout the remainder of the year and in 2019. Okay, let's shift gears and take a look at the total number of transactions in the industrial market this past year. As predicted, we saw another drop. I've talked about it these past couple years, and owners of industrial real estate don't like to sell. They like to wrap their arms around their assets and try and lease out those buildings. And Nick will talk about, you know, your return on your investment here in a little bit and give an example of that. But we're just seeing fewer and fewer properties come on the market for sale. I do want to highlight one thing, and that's that gap that you're seeing between transaction and total dollars spent, which were $32 million spent in industrial sales this past year. The market's getting a little frothy. What that's telling us is that people are paying a premium for industrial real estate when it comes on the market. If you can't find an existing building, your only option is to go out, buy land, and build new, which is part of the reason why we've seen this uptick in new construction. Okay, the health of the industrial leasing market. Not a whole lot has changed here. We did see about a 25 cent per square foot jump in both the throughout the remainder of the year. Okay, before I jump into my conclusions and predictions, I wanted to highlight two trends. One that we're seeing on a local level, and then one that's rearing its head on a national level. The first one being one that Reggie's actually talked about in his retail presentation in the past, and that's the last mile. A lot of people are not familiar with the last mile. They're familiar with the term, but they're not familiar with the concept or how it works. So I took this infographic from CBRE's research team, and hopefully this helps explain what's going on. I want to use the book industry as an example. Imagine Barnes & Noble on the left and Amazon on the right. Traditionally, you would have a regional distribution center that would send out all these books to a local warehouse. That local warehouse would then mass distribute it to a bunch of other bookstores within the region. Barnes & Noble in this scenario. We, the consumer, would then go to the store, purchase our book, and then head to our destination, the Caribbean or wherever you go, to lay on the beach and read that book. Which sounds pretty good, considering what we had with snow just this past evening. With the advent of e-commerce, this has really changed things, i.e. Amazon. So now you can sit in the comfort of your own home, you can type on your laptop, hit buy now. Now they even have the one-click thing where your credit card information is already in there, and you can buy that book. A lot of us like to read on our phones or on a Kindle. In this scenario, I'm using this as an example of us actually purchasing a book. So Amazon has a fulfillment center up in Shakopee, Minnesota, along with many other parts of the country. When you hit buy now, all of a sudden that fulfillment center processes that order. They put the book in a box, tape it up, throw it on a pallet with a bunch of other products, and that ships out to a local hub. That local hub then sends it to your front doorstep, a lot of times within a day or two. Some of the bigger cities are seeing same-day delivery. That's the last mile. It's that last leg from the local hub to your front doorstep. And so hopefully that helps give you a better idea of that trend. And we're seeing that on a local level. So some companies like Lanter Delivery or Lennox Parts Plus, we're seeing those companies come to our market. So the second thing that I wanted to highlight, and it's being coined as the Airbnb of warehousing. Many of you are familiar with what Airbnb is and what it's done for the residential market. Well, there's companies such as Flex, LogHub, and many others that have created a cloud-based platform for warehousing. So let's use the example of Company A needing some short-term warehouse space, and Company B has some excess warehouse space, dead space we like to call it, that they're not utilizing maybe 6 months out of the year. So to fill that void, these companies have created a platform for those companies to communicate with one another and do short-term warehousing in some of that dead space. This is something we're seeing on the coasts in a lot of the major markets. It hasn't really hit here yet locally, but it's something we will definitely keep an eye on and report on in the future. Okay, as far as conclusions and predictions, record new construction in 2017, vacancy increased, we saw a drop in sales transactions, fewer and fewer properties are coming on the market, and we saw a slight uptick in rental rates. Excuse me. For 2018, I think it's going to mirror 2017. And when I say mirror, I don't want you to get confused by the up arrows and the sideways arrows. It's going to be another strong year. I don't think we're going to see huge increases though. So I think we'll see right around the same numbers as we did in 2017. Moving to my real estate cycle, high new construction, absorption, and some rental rate growth. That puts us in expansion. However, we're starting to see an increase in vacancy. So I'm putting us right at the tip there for 2017. So with that, I'd like to bring up Nick Gustafson to report on the investment market.
Thank you, Rob. In this portion of our presentation, we focus on investment properties. We're going to take a look back at 2017 and take a look at local and national trends, and we'll make some informed predictions about 2018. Well, as we know, investors have a lot of options when it comes to investing capital. This can range from cash, commodities, equity markets, real estate, or the core business or career that made the money in the first place. Well, we know that we've been buying and selling real estate for a long time. It's one of our oldest asset classes. For 4,000 years, human beings have been buying and selling real estate. In fact, Hammurabi's Code in ancient Babylon mentions real estate transactions several times. Why does real estate belong in our modern portfolios? Let's take a look at a building that our firm leased in 2011 to a Fortune 500 company. Shortly after leasing this property, we sold it for our client for $500,000 or an 8.5% cap rate. After 7 years of great cash flow, this property is now worth $760,000 or a 49% increase in value. Let's see how this stacks up against several other asset classes. You see the Dow Jones, S&P 500, a Treasury, and ignore all this volatility. Focus on the red bar, which shows stable cash flows, and cash flows and appreciation and local control continue to make real estate a great investment option. We're going to switch gears here, and for the next two slides, look at global and national data. And this shows national commercial real estate sales volume going all the way back to 2007 for properties 2.5 million and above. Look at this. Big run up in 2007, no surprise, recession, and then we recovered, but note that we flattened out a little bit. This is a classic sign of a maturing cycle. Let's take a look at the other end of the coin, or the other side of the coin. This is global private equity real estate fundraising going all the way back to 2000. Again, the big run up, the recession, and a slight pullback. Why are people not investing as much on the national or global level? Two reasons. Number one, prices have increased, and there's not as much low-hanging fruit here, so investors have noted this and backed off just slightly. Let's take a look at the Sioux Falls market, and we'll do this first by showing a multifamily. And in multifamily, this graph shows new unit construction all the way back to 2004. From 2010, multifamily developers have been aggressively building new units. Let's take a look at how this has affected vacancy rates. We've got two bars here. The first one's the blue bar, and this shows U.S. multifamily vacancy. Note how healthy it is right now. And the yellow bar, which is Sioux Falls conventional multifamily units. It's been really highlighted in news, and we talk about it a lot. This 11.5% number looks really scary, especially when you take a look back in reference to the last peak, which was in the recession in January of 2010, 14%. What's going on here? Well, this 11.5% number is 100% supply driven. We're just building a few 2 units right now. We don't nearly have all the recessionary factors that we had in 2010. Look for developers to exercise some caution in 2018. Well, we noted that the U.S. multifamily vacancy rate was really healthy. Why is that? Well, take a look at this red bar. This is the United States home ownership rates going all the way back to the late 60s. Look at that. We're in a historic low for home ownership. Note the top bar is the Midwest, and that probably reflects our affordable homes here in the Midwest as opposed to the coast. But look for multifamily on the national level to be healthy for several more years. So all these people in the United States and in Sioux Falls are tenants. What are they looking for when they choose apartment buildings? Everyone likes the idea of a weight room and a pool, but when it really comes down to making a decision, rent, the price of the unit per month, and the location are the main factors in that decision. Let's take a look at sales. This bar shows sales transactions in dollars all the way back to 2006. So clearly in 2017, we had a pretty stable year. It was a good year. 33 transactions, 4 units and above, and roughly a $32 million in transactions. That's a pretty healthy year. In 2018, I predict we'll have a very similar year, actually a little bit higher. So things are going to be good in the upcoming year. We're going to take a look at some individual transactions that happened in Sioux Falls in 2017. And first, I want to show the national cap rates for these asset classes and contrast them with Sioux Falls. And we'll come back and revisit these in our conclusions. But note that Sioux Falls has higher cap rates or higher yields than we have on the coast or nationally for that matter. And that really reflects the size of our market and the fact that properties don't appreciate quite as quickly as they would, say, in LA. Let's take a look at some individual transactions. First, we have a really nice multifamily development, $5 million, and this traded at a 7.13% cap rate. Next up is a late 70s development, $2 million deal, 6.25%. Wow, that's amazing. Western Park off of 46 and Western, $4 million deal, a 6.5% cap rate. Beach Pay, this is a beautiful historic building with multi-tenant office and retail, sold for $2 million or an 8% cap rate last year. Just down the street, the Foundry Building, $4 million deal, 7% cap rate. We have some modern East Side retail here, trading at a 6.79% cap rate. And Dairy Queen, wow, almost $800 a square foot. What happened here? Well, this sold as an investment property on a 20-year lease at a 5.5% cap rate. I think that $800 nearly is a record. Midco, this was a huge transaction in our market. This is a call center, $20 million deal at a 7.5% cap rate. This is a building in Rob's industrial market, Amesbury Truth Building, sold for $18 million or a 6.82% cap rate. So last year, multifamily and retail were down slightly in terms of transactions. Office was up. Based on what we're seeing and based on last year's information and what we're seeing today, I predict all 3 asset classes are going to see more transactions in 2018. Cap rates will stay 6.5 to 7.75 in multifamily and retail. Let's wrap things up here. Clearly, we have overbuilt the multifamily market with too many units. I believe in multifamily developers are going to pull back in 2018, and you'll see those vacancy rates drop. 2018 is going to be a very steady year for transactions. I think interest rates are going to continue to go up, and they're going to keep cap rates stable or maybe go up just slightly. A note of caution, on a couple of slides we saw signs of a maturing market. I believe investors should be somewhat cautious in structuring their financing for 2018 transactions and making leasing predictions in their transactions as well. Let's end here with the multifamily real estate cycle. Given our high level of vacancy and our high level of construction, this puts 2017 firmly into hypersupply. If developers exercise discipline and caution in 2018, we'll probably see this asset class remain in hypersupply or in a mature market cycle. With that, I'd like to bring Michael Bender up to wrap up the presentation.
Well, 53 minutes. I think we did it. So we get pretty granular and we focus on industry types, we focus on sectors of the market, locations. And it dawned on us this year that we almost get too granular. So we created a data point and a heat map here that I want to show you. What we did is we took all building permits throughout the 5-year history for residential. We clustered them into general geographic areas. They're not specifically dots of where things were, but general geographic areas. And then we overlaid residential with multifamily. And then finally what we did is we overlaid that with the commercial. And what I want to point out really is how uniform that development looks. You saw earlier the land sector and how it's more in that southeast portion. But you look at this and you say, it's pretty well uniform throughout the entire community. That is a great relationship between the public and private sector. The public sector knows where infrastructure needs to go, and then the private sector follows. And so this, to me, is what we want to end on. We want to end with, we're in good hands. And as we go into this year, 2018 and beyond, yes, we may see a maturing cycle and a dip or two, but long term, we're in great shape, and we're going to see uniformity with our development throughout the community, which is going to bode well long term for our citizens and for our businesses. So it's with that I want to leave you with that we have a very prosperous year and a great new year for 2018. I do want to thank Summer Hoffman, who's always up in the booth, and she's our Director of Research, and Summer does a great job. This is her 20th year. She only missed the first year, I believe, in doing this, and it's research. So with that, you are all adjourned, and have a great year.